Annette Howland. I'm a senior financial advisor with MD Management in Halifax. I'm here today to talk with you about financial planning. Financial planning can be very complex. However, today I'd like to help simplify that for you. Financial planning is really an opportunity for you to control your money. How you do that is by assessing first and foremost your current situation. Sometimes that can be the most difficult step because people don't know where to begin. As a financial advisor, my goal is to help you make that simple. So first of all, what we like to do is sit down and really have an in-depth discussion on where things are for you today. As a medical student or resident, perhaps the situation is that you have debt. Medical school's expensive. However, this is the perfect time to really consider what your financial plan should look like. So we're really here to help you do that today by talking about some of the topics that are very important to creating and maintaining a solid financial plan. So when it comes to financial planning, the question would be, well, what exactly is a financial plan? So a financial plan, first of all, is a roadmap to help you get to where you need to be. Part of determining where you need to be is to sit down and really consider, well, what are my goals? Because certainly if you don't know where you're going, any road will get you there. What we like to do is really assess your situation. So in terms of your financial plan, what we need to do is gather information, evaluate the current situation, and then make recommendations to help you get where you want to be. Some of the key considerations folks would have at this stage might be, well, I have all this debt, so maybe that's all I should focus on. However, there are other things to consider. One being, what's the long-term objective? Paying off debt is certainly important. However, there are other considerations to bring into play to help you reach that goal, such as, should I start investing? Certainly as a resident, investing is extremely important. As a physician going forward, chances are you won't have a pension plan that will be paid for or looked after. You need to do this yourself. So part of the consideration is, well, do I start investing before I pay off the debt? Or should I look at paying off all the debt first and then investing? One of the key considerations there would be taxes. Nobody really likes to talk about that a whole lot at this stage, but what you're going to find is that's going to be one of your biggest liabilities, even bigger than the debt you're looking at right now. So if you don't acknowledge these other aspects of your financial plan and only focus on paying off debt, you might regret that decision down the road. So putting a financial plan together in cooperation with your financial advisor involves some steps. One of the most important ones will be gathering some information about you and your financial situation. That will help the advisor evaluate your situation to make specific recommendations to therefore put the plan into place. Once the plan is put in place, it's very important to continue with monitoring that plan and also making changes as the situation changes both for you and the environment when it comes to the financial planning industry itself. A comprehensive and solid financial plan will include various components. One thing that's very important, and maybe you don't think about when you're looking at your money, is insurance. Risk management is very important to analyze as part of a financial plan. So that means insurance, such as disability insurance, property insurance, life insurance. Sometimes perhaps critical illness may even be something that's important to consider at this point in your career. When you're looking at investing, RSPs, tax-free savings accounts, non-registered investments, RESPs for your children, and even corporate investing all make up a solid financial plan. In terms of this, you really need to look at what are the strategies. Sometimes there isn't just one. Maybe in your particular case, some options might be needed to be able to make the best assessment and decision for your own situation. Your financial plan will include things such as savings, investing, debt management, tax considerations, insurance, and a solid plan for the repayment of the debt in balance with other things such as investing, and again, that critical piece, tax planning. When you take the time to really assess your current financial situation, several things are going to come up. One will be, how much do I owe and how much do I own? What that creates is a net worth statement. The net worth statement is really the underlying driver to a solid financial plan, because year over year, what you're hoping for and looking for to achieve a successful financial plan implementation is that net worth gets better and improves. Keep in mind, if you're a medical student and you're accumulating debt, that's normal, that's natural, that's going to happen. What you probably want to know is, are you in range with everyone else in terms of being able to deal with that once you get out of medical school? Again, a solid financial plan with a solid financial advisor is going to help you achieve that. What underlines the net worth statement is your cash flow. Year over year, if you have more money going out than money coming in, that's going to result in a negative for your net worth statement. Again, as a medical student, That's going to happen. However, it will turn around. When you start working as a resident, you have an opportunity to start making a dent in your net worth and improving that year over year. As a practicing physician, we certainly look to achieve year-over-year results of 15 to 20% improvement in your net worth. That might sound daunting, but with a solid financial plan, we can help you do that. One of the things that can put a financial plan at risk is number 3. If you haven't assessed your need for insurance, we strongly recommend that you do that now. That's something that's very important and involves solid disability insurance and an assessment of your life insurance needs given your personal situation. Now let's look to the future. Let's look at your financial goals and how you create those and establish those in line with what you want for your future. Sometimes looking to the future can be difficult and daunting. So what we like to really try to help you think of is imagine your life 10 years from now, 15 years from now. What does it look like? And then what we do is try to help you establish what underlying things have to occur so that your financial plan can support those goals and objectives. Some of the things that are difficult to look at might be the reality that there could be restrictions on your cash flow that have to be addressed. We will help you do that through a cash flow analysis and comprehensive review of your net worth statement going forward. Once your goals have been established, then it's a matter of creating what I'd like to call a living document, that living document being your financial plan. One of the key aspects of that is going to be the action plan. What steps have to be put into action to make those goals become a reality? One of the things you'd be looking at would be, well, how much do I save? How much do I invest? And with what? Do I invest in an RSP, a tax-free savings account? Do I do both? Your financial planner will help you assess what's right for you. Within those accounts, you're also going to find that there are more choices to be made. What type of investments do you hold inside the RSP? What type of investments do you hold inside the tax-free savings account? Do you look at GICs? Do you look at investing in the Canadian market through mutual funds or individual stocks? Do you look at investing in the US and international markets as well? Sometimes that sounds a little scary and then everybody just wants to retreat to paying off debt. But remember, that's only part of the plan, not the only thing. It's important to start branching out and learning about what's available to you to optimize your financial strategy so that the action plan you put into place best serves your needs. Once you've established your financial goals and objectives, it's time to put a plan into action. The financial plan is something I like to call a living document, meaning that it's going to be reviewed periodically. However, before that periodic review can take place, the financial plan has to be constructed. Part of it is establishing an action plan. What steps need to be taken specifically, both by you and your financial advisor, in order to ensure a successful implementation of the optimal financial plan for your situation. How much do you save? What makes sense in terms of where to invest those savings? Do you invest in an RSP, tax-free savings account, a combination of the two? And then from there, within each of those options, there are a myriad of choices of what types of investments you can have. You can have cash, you can have GICs, bonds, stocks, mutual funds. There's the Canadian market, the US market, the international market, and the list goes on. In order to determine that, sitting down with your financial advisor and really digging into what makes sense for you from a risk perspective is absolutely key. You'll also need to address your insurance situation. What do you need to get in place? What do you have now versus what should you have? In terms of your debt repayment, a plan, putting that in action to determine what you need to do to ensure that that plan takes place and goes forward accordingly. Let's talk about managing debt. We're looking at debt from 3 different perspectives, one being good debt, one being bad debt, and the other ugly debt. So good debt would be the money that it costs to get you into and through medical school, because that type of debt is going to provide you with an income in the future. So when we talk about good debt, that's what we're looking at this point. In terms of bad debt, well, bad debt may be something like a car loan. You may be in a situation where you need a car, however you don't have the money to buy it up front. However, it's going to get you back and forth to work. So that's something that's very important. The only thing is, and why that's not considered good debt, is it's a depreciating asset that's only going to cost you more money down the road. Then there's the ugly debt. The ugly debt being that which, although it might feel good at the time to spend the money on such a thing, it's going to cost you a lot more in the long run to pay that off. An example might be a whimsical trip, perhaps retail therapy, Those are the kinds of things that we would consider ugly debt because they're not something that's going to really work for you either in the short, mid, or long term. Managing debt is an ongoing process. Part of it would be determining exactly what you need the debt for. An example might be a house. So you may pay off some of your good debt, even maybe some of your bad debt. However, then you may get into more debt again. So debt is something that's not going to go away in the short term and something that really needs to be managed. And how that can be managed is to have it built into a solid cash flow plan, also known as a budget. Let's look at some tips to making that budget work for you. First of all, with regards to your debt, let's look at interest. Is the interest on the debt that you currently have deductible, such as from a student loan? Now, if you're thinking of going into rural or remote family medicine, it's important to keep in mind that the federal government currently allows for up to $40,000 of that to be forgiven through a loan forgiveness program. These are things that a financial advisor who works specifically with physicians can be sure that you don't miss. In terms of your overall budget, some of the tips you may be looking at would be assessing how much money is actually going out every month. How much do you really need? This is the key piece to determining exactly what your budget is going to look like. When you make your budget, keep in mind that paying off the highest interest debt first may in fact be the best thing you can do, because every dollar that you're not spending in interest, that can go somewhere else to optimize your financial well-being. Looking at your debt can be scary. However, it's something that has to be done. It's like the elephant in the room. It's not going to go away. We understand that. We work with physicians. We've seen a lot of debt, and we've seen that debt get paid off. That can happen for you as well. You really have three options when it comes to how to deal with paying off debt and investing. You can look at only paying off debt, which might seem like the comfortable thing to do. You understand the debt, you know the debt, you've had the debt a long time. However, that really can be more of an emotional decision than a sound financial decision. Then you can look at, well, maybe I shouldn't pay off debt. Maybe I should invest everything. Investing over the long run has extremely great returns in relative comparison to the prime lending rate. So in theory, if you torture numbers long enough, they'll tell you whatever you want. So when it comes to that, be cautious of that strategy of investing only and ignoring the debt. What we like to look at is a combination approach. How that combination will actually come into effect will depend on your own financial needs, financial goals, and your ability to handle risk as well as your capacity for it. So what we look at, however, is a combination is usually the best approach, as it really identifies that you're paying off debt, but also saving for your future, so that one day you won't have to worry about where your money's going to come from. You'll be in a financially prudent situation where you're able to generate income to support you when you're no longer able to work for money. In financial planning, like in medicine, there's something called jargon, and what those jargons can be in the financial planning world are actually the vehicles that you use to invest. So let's talk about some of those and clarify what they actually mean. RRSP, that means Retirement Savings Plan. The R on the front actually means it's registered. It's registered with the government in order to obtain a tax-preferred status. So what happens is any money you put into the RRSP, the Registered Retirement Savings Plan, the government allows you to take a tax deduction in that year or a future year against your income, thus deferring the payment of tax on that income to a future time. The objective being that the money you put in is actually tax deferred at a higher rate than the money you're going to be taking out in a future year. It's really the replacement of a pension plan for physicians and a key cornerstone to a solid financial plan. TFSA, that stands for Tax-Free Savings Account. It came into existence in 2009 under quite a bit of confusion and misinformation. What is tax-free about that is the income that you earn on the investment inside that investment vehicle. In order to ensure that your tax-free savings account is making sense for you, it's very important that your financial plan really talk about why you'd be doing that versus some of the other options. Another vehicle that's very important to consider if you have children is an RESP. That stands for Registered Education Savings Plan. When you put money into that plan, you're able to get a grant known as the CESG grant, the Canadian Education Savings Grant. It's a nice way to get some free money from the government. Again, you'd want to look at your overall financial plan to ensure it makes the most sense given the stage you are at that time.